Hi everyone, this is Michael, the investor, broker, and appraiser, and today I'm going to talk about how you can save thousands on your mortgage. It's always crazy to me the amount of people that I talk to who have mortgages, but they don't understand how the interest is calculated and how the mortgage loan works. So I'll start by briefly explaining that, and then I'll quickly show you how you can save a ton of money on your mortgage. So briefly describing the mortgage loan, it's a simple interest loan. Interest is calculated, so it is front-loaded, meaning that you might pay 90% interest and 10% principal in your first year, and in the last year you might reverse that, and it might be 10% interest and 90% principal that you paid in the final year. That's how the schedules kind of work, somewhat like that. And to kind of demonstrate that, I'll show you here. I've pulled up a amortization schedule of a 5% loan at 30 years and a loan amount of $500,000. As you can see, the amount of interest progressively gets less and less each year as you pay. And the amount of principal that you pay progressively gets more and more each year. This first year is this first year is an anomaly because it's only like a half year, so it's not going. But basically, as you continue to pay, the more principal will go toward each payment. Each payment will be more towards principal than interest as you continue to pay. And the way that you can save money is you just have to pay lump sums more toward the start of your mortgage than towards the end. So what that would look like is, say you made a $25,000 lump sum payment and you brought the balance down to $475,000. So you would, on that $25,000, you would yield $23,000, $24,000, $24,000, and $6,000 of interest, which, you're looking at somewhere around $80,000 there if you calculated those figures. And that's just off your $25,000, where if you put that same $25,000 down at the end, you're only looking at saving roughly $2,500, maybe, something like that. You can see the difference is significant. So kind of the advice that I would give here and what I would try to get somebody to understand is that making large principal balance towards the start of your loan, your mortgage loan, will yield tremendous benefit and it will save you a tremendous amount of money. And this is true whether it's just $1,000 or $100,000 that you put down at the beginning of your mortgage. The money that you save is just many times that, double or triple, depending on when you put it down. I've pulled up another monthly payment here to demonstrate what that looks like monthly. This is the same schedule, but it's broken down monthly rather than annually. And you can see that for that same $25,000, if you put it down at the start of the mortgage, each payment now is worth $100 more. So instead of paying $600 in principal as you would, you're now paying $700 per payment going down towards your principal, paying the balance down. And if you did that again, it just brings it down further and further. So you pay more and more principal. The more money that you pay down, or the more that you pay down, it saves the interest. So when you do make lump sum payments, you're no longer responsible to pay the interest that is on this left-hand side. So let's say, for instance, you wanted to just make it a 15-year mortgage and you paid $165,000 down after you just got it. you would save this whole left-hand column of interest, and you'd only have 15 years left to pay. If you calculated this, that $165,000 would save you, if you calculate this, I'm sure it's well over $250,000 or something like that. And you'd only have 15 years left to make payments. It doesn't have to be as dramatic as, $40,000, $50,000, $200,000. You can do it with $1,000. If you just made $1,000 extra one month or the next month, and instead of putting that in the savings, you put it down towards your mortgage, it would yield that same benefit. That $1,000 would yield you, let's just say here, we'll just look at this quickly, that if you put $1,000 down one month, it would save you roughly, well, let's just say here, let's just go from this year to this year, and we'll say that you put $500, it looks like roughly $500 down. That would save you, about $2,000, just that $500 in interest. And the objection a lot of people would have towards this type of strategy is that, okay, maybe I'm saving up for school or something else, so I've got to have that money in cash. And then my advice at that point would be to still look at doing the lump sum, because you can always take this money, draw this money back when you need it through a home equity line of credit or something like that. And in the meanwhile, while you're saving, you can make your money work for you by paying down the lump sums and getting rid of that interest. So the basic point is that if you have a mortgage and spare money of any amount, then it's good to pay down lump sums. And, I would say what I typically do is I do this exact thing, and I keep a certain amount of cash reserves for emergencies, but anything over that, I'm just paying down mortgages. And I see which mortgage is the youngest or has the least principal paid down, so it has the greatest effect per the amount that I put down. That's basically how I do it myself. So I guess the basic point of this video is to say that make your money work for you. Don't just put it in the bank. And one way that you can make your money work for you very easily is, and this is with a click of a button. You can have one bank here, and then you can click the button and transfer that from this bank to the other bank with your mortgage, or you have the mortgage in the same bank, and one click, transfer the money. You saved all that interest with just a transfer of the money. And thank you all for watching. Have a good day, and I'll see you in the next one.